we generate financial statements. And the first we'll do is income statement, then balance sheet, then statement of shareholders' equity. So let's go back in. And I've pre-populated the items for the statement and for the balance sheet anyway. So let's do the income statement first. So we have revenues. And so revenues are plus 233. Next item is cost of goods sold. Cost sold. And so that is, and I'll just show it as 40. The subtotal now is gross profit, which is 233 plus 140. Which is a negative 93, and then we have expenses. And what do we have? Operating expenses. And we have quite a few of those, so we'll go plus, and we'll look on top. And here we do a little careful hunting and pecking here. So we had that item, and we had that item, and depreciation and amortization. These are all operating expenses. And so net of that is operating income, plus gross profit, plus the minus number, 71. Then we have other income expense. And here we have interest expense. And we also have interest and dividend revenues. So let's start with interest expense. It's right here, 514. And interest dividends was right there. And so now we have pre-tax income, which is operating income plus those two items. 72. Next we have income taxes. And we paid taxes here, 19,121. And the bottom line is net income plus pre-tax, and this 53,394. All right, now we can pull together the balance sheet. So I've put the categories on the left, and let's pull the numbers. So cash, what is cash? It equals this number in the trial balance, 21,120. Next is what's accounts receivable. Same thing. We have it there, 16,000. Inventory. I'm sorry, we lost marketable securities, or left it out. That's 20,000. Accounts receivable is the 16. Inventories is this number. Other current is this number, 8028. And we can pull the subtotal. So this is current assets. Next we have long-term marketable securities, which are right here, 164. We have property, plant, and equipment net, which is the gross minus the accumulated depreciation. And we have other assets of 14. So our total assets are 290, and I'll just make that number more prominent. And we'll compare to liabilities and equity. So here we can go with accounts payable, which is 35. And then we have expenses of 25, and deferred revenue of 8,900. Commercial paper, which is our short-term payable, and the current portion of long-term debt, 2,500. This subtotal, this is a sum command. Then we do long-term liabilities of deferred revenue, and we do long-term debt, 53,000, and next is other. And so our total is 171 in liabilities. Then we have our equity accounts, which are common shares of 27, retained earnings of 92, and OCI of that. This number equals this number, that and that. So we are in balance. And I'll pretty it up with some underlining just to show you how the subtotals work. So we're going to underline that. And we're going to underline this. And we're going to double underline this one. Okay. On liabilities, we have current. We're going to underline that. And we have non-current or long-term, underline that. And we have equity, underline that. And the bottom line, we'll do double. So this is in better form. So we could see that current assets equals this, current assets equal this, long-term assets lead to total assets of that. On the liability side, we have current liabilities, we have long-term liabilities for a total liability of 171, and we have these three elements of equity equals 119. 171 plus 119 is 290. We are in balance. All right. So now we can do the statement of shareholders' equity. And here's just a layout of the statement. And we have the four categories: common stock, AOCI, accumulated other comprehensive income, retained earnings. And then we have the changes that occurred this year. We'll start with the beginning balance, ending balance. And in the middle, we show common stock issued. We show net income for the year, dividends, and any adjustments. So let's start with beginning balances. Common stock is at the very top, is that number. AOCI is this number. And retained earnings plus is this number. Okay. Next is we add common stock we issue this year, is in this column. And then notice on top that in the common stock column, there are no other entries. So we know we're done on that. AOCI, we had an adjustment made there. That's the only change. So we'll just put here adjustments and go pick up that number. Then on retained earnings, we know we have net income, which we can grab from our income statement. That's 53. And we have dividends during the year. We know we paid $11,000. We had one adjustment that we made during row 16, or on row 16, which is right there. And so now we have this as our balance in shareholders' equity, which exactly matches this. Actually, use a different color. And each of the components also equals that. So 27, 345, and 92. Okay, so that's it. We've generated financial statements. The income statements, if you look at our spreadsheet, they exactly equal the statements for the income statement. That's the 53,000. It's right there. 53,000. 394. And then next we have the balance sheet, and the total assets are 290,479. Here we have over here 290,479. And then the shareholders' equity of 19,355, and that is below 19,355, right? So these are the formal statements, and this is the spreadsheet that generated the data to show we can do it on our own. So finally, the fourth statement, cash flows. This is the trickiest statement of all, and I'm not going to have you produce these in any test or quiz. And I will, for those of you who are interested in doing a statement of cash flows, I have a method that I use that makes it a lot easier, and I will do that as an optional video. But nothing you would ever be accounted for is only for those who are interested in seeing the mechanics of how to generate a statement of cash flows. And closing process. When we close a year, we have balance sheet, then activity, then the ending balance sheet, right? Then now this becomes the beginning balance sheet, so we have to clear the decks of all the other accounts. So the closing process is simply taking all the income statement accounts and putting them all to zero by closing them out to retained earnings. That's why we use the word closing. In the spreadsheet, we kind of close along the way, because you notice that every time we had an income statement item, we showed the direct impact to the retained earnings account. That is that whole if command. And so that's how we've been doing it. But if we do it formally, you don't have all this back and forth plus and if commands. You simply just post to the accounts, and they could be balance sheet or income statement. And at the end of the year, you close out in one big, huge entry all the transactions in the income statement into retained earnings. Whereas in our spreadsheet, we just do it one at a time. So we don't even have to do a closing entry. Mod 3, we have finished transactions, and we looked at the accounting cycle, which goes through beginning balance, transactions, adjustments, trial balance, statements, closing, and then over and over and over again. We also did some work on transactions. We looked at a very simple example of like 5 or 6 transactions. Then we jumped into something deeper, which is reflected in our textbook, to show how we can record the 20 some odd transactions in order to get to Apple's income statement, balance sheet, statement of shareholders' equity. Close the books, we just described a moment ago as zeroing out all the income statements and closing them to retained earnings, so we could start at 0 for the next. Congratulations, that's the nitty-gritty of accounting, how to do entries, statements, and close books. Mod 4, which we'll do in a separate video, covers the basics of financial analysis, and we're going to use ratios and other techniques that will give us ways to look at one company against itself over time, or one company in comparison with another. So that's also a very, very important chapter. So these 2 chapters are key to the entire course, how accounting works and how financial analysis works. So thank you, and see you soon.